Silver just hit $75 an ounce in Shanghai. Not London, not New York, Shanghai. And while you were scrolling through your feed, Western banks went into full crisis mode behind closed doors. What if I told you this wasn't a market anomaly? What if this price spike was the first crack in a 50-year financial weapon that has been pointed at your savings account since 1971? Right now, you're feeling it. Your grocery bill is up 30%. Your rent eats half your paycheck. You're told it's transitory inflation or supply chain issues. But the real story is being written in precious metals markets halfway around the world. It's about to reshape everything you thought you knew about money. Drop a comment below. Where are you watching from? Because this story connects us all, whether you're in Texas or Tokyo. And if you want the unfiltered truth about how the financial system really works, hit that subscribe button. You'll need it for what's coming. Let me show you the receipt. August 15th, 1971. President Nixon walks into the Oval Office and commits the greatest financial heist in human history. He closes the gold window, severing the dollar's link to physical gold. Overnight, the global reserve currency becomes backed by nothing but a promise. The official story? It was temporary, a necessary move to protect American gold reserves from European redemptions. But here's what they don't teach you. It was permanent from day one. And it unleashed the paper gold system, a shadow market where banks could sell gold they didn't own in quantities that didn't exist to suppress prices and maintain dollar dominance. Sound familiar? You can't buy a house without getting priced out by corporate investors. You can't save money without inflation eating it alive. The dollar in your pocket is worth 98% less than it was in 1971. That's not coincidence. That's policy. The London Bullion Market Association and COMEX became the gatekeepers. Through futures contracts and unallocated gold accounts, Western banks created a system where paper claims on gold outnumbered physical gold by ratios estimated between 100.1 and 500:1. Think about that. For every actual ounce of gold in a vault, there are hundreds of paper certificates claiming ownership of that same ounce. This is fractional reserve banking applied to precious metals, and it works perfectly until someone asks for physical delivery. China started asking in 2009. Russia started asking in 2014. India, Turkey, Poland. Central banks worldwide began demanding physical gold instead of paper promises. Between 2009 and 2024, central banks accumulated over 6,000 tons of gold, the largest buying spree in 55 years. Sound familiar? When everyone rushes for the exit, someone's getting trampled. But gold was just the opening act. Silver became the main target because of one critical difference: industrial demand. Solar panels, electric vehicles, electronics, medical equipment. Silver is irreplaceable in the technologies powering the modern world. Unlike gold, you can't just hoard silver, you have to consume it. Global silver supply peaked in 2016. Since then, annual deficits have drained above-ground stockpiles by an estimated 1.5 billion ounces. The U.S. Strategic Silver Reserve sold off completely by 2002. Government vaults are empty. Yet, COMEX still trades 300 million ounces of silver daily in paper contracts, while holding only 280 million ounces of physical silver in total inventory. The math doesn't math, and Shanghai just called their bluff. Here's where it gets wild. The Shanghai Gold Exchange operates differently from Western markets. It requires physical settlement. When you buy silver in Shanghai, you get actual metal, not a paper promise. No fractional reserves, no indefinite rolling of futures contracts. You buy silver, you get silver. This creates a massive problem for Western banks running the paper suppression scheme. When Shanghai prices diverge too far from London and New York prices, it reveals the truth. There isn't enough physical silver to satisfy even a fraction of the paper claims. The whole system depends on nobody asking for delivery. For decades, they kept a lid on it through coordinated trading, strategic short selling during Asian market hours, and conveniently timed maintenance outages whenever prices spiked. There's a term for this in trading circles: spoofing. Banks place massive fake orders to manipulate prices, then cancel them before execution. JP Morgan paid $920 million in fines for precious metals spoofing in 2020. That's not a conspiracy theory. That's a Department of Justice settlement. But now China controls the physical silver supply chain. They mine 14% of global silver. They refine 30% of global silver. They manufacture 80% of the world's solar panels, which consume silver. And they've been accumulating silver through their state administration of foreign exchange since 2015. When Shanghai silver hit $75 while COMEX silver sat at 32s, the spread revealed something catastrophic. Price discovery has split between paper markets and physical markets. The derivative is becoming worthless, while the underlying asset moons. You won't believe the mechanism they're using to keep the scheme alive. And the receipt is wilder than you think. Let's break down exactly how the system works and why it's collapsing right now. COMEX silver futures allow banks to control massive quantities of silver with minimal capital. A single futures contract represents 5,000 ounces. At $32 per ounce, that's $160,000 worth of silver, but you only need $10,000 in margin to control it. That's 16.1 leverage. Now scale it. 8 banks hold 72% of all commercial short positions in silver futures. 8 banks. That's $48 billion in concentrated short exposure as of the last Commitment of Traders report. When prices rise, those banks face margin calls. They must either post more collateral or close positions by buying back contracts, which pushes prices even higher, triggering more margin calls. This is a death spiral feedback loop. But here's the genius and the greed. They never intended to deliver physical silver. The entire scheme relies on rolling contracts forward indefinitely. You short silver at $30, take the cash, invest it elsewhere at higher returns, then close the short position before delivery by buying a new contract for the next month. Rinse, repeat. It's free money, as long as nobody demands physical delivery and breaks the chain. Shanghai just demanded physical delivery. At scale, and Western banks don't have it. This isn't some rogue operation. This is institutional infrastructure. Bullion banks like JP Morgan, HSBC, and Scotia act as market makers in precious metals. They're supposed to provide liquidity, matching buyers with sellers, but they also take proprietary positions, meaning they bet with their own money. The Bank for International Settlements reported that over-the-counter precious metals derivatives totaled $490 billion in notional value as of June 2024. That's derivatives, bets on silver prices, not actual silver. This dwarfs the physical silver market, which is only worth about $28 billion annually in mined supply. You're looking at a $490 billion casino built on a $28 billion foundation. The illusion only works if the casino chips never get cashed in for real silver. When you see silver traded on financial platforms, 95% of it never touches physical metal. It's synthetic exposure through exchange-traded funds that hold paper claims, not proportional metal. Unallocated bank accounts, where your silver exists as a ledger entry, commingled with everyone else's. Certificates of deposit backed by silver, the bank doesn't segregate or even necessarily own. Futures contracts settled in cash instead of metal. The largest silver ETF, SLV, manages $11 billion in assets. But its prospectus explicitly states that during extraordinary circumstances, it may suspend redemptions or deliver cash instead of silver. That means legalese 4. We don't have enough silver to cover redemptions if everyone asks at once. Sound familiar? That's a bank run waiting to happen. And Shanghai just yelled fire in the theater. Why suppress silver prices? 3 reasons. First, dollar hegemony. When precious metals rise, it signals dollar weakness. Central banks and governments need cheap metals to maintain the illusion of currency stability. A $75 silver price in Shanghai undermines confidence in the $30 price in New York, and by extension, confidence in dollar-denominated assets. Second, interest rate suppression. Precious metals pay no yield. They compete with bonds. When metals surge, bond markets panic because investors flee to hard assets. Central banks have kept interest rates artificially low since 2008 through quantitative easing. Rising silver prices expose the moral hazard of that policy. Third, commercial interests. Mining companies sell future production through forward contracts to hedge price risk. Banks, on the other side of those contracts, profit when prices stay low. It's a parasitic relationship where producers give up upside while banks collect premiums. Between 2011 and 2020, silver prices dropped 63% despite industrial demand growing 34%. That's not a free market. That's engineered suppression. And it worked perfectly until China decided to stop playing along. Here's what happened. On December 18, 2025, Shanghai silver futures for March delivery hit Y Basmar of 525 per kilogram, equivalent to $75 per ounce. COMEX March silver, $32. That's a 134% premium for physical delivery. Arbitrage should close that gap instantly. Buy on COMEX, sell in Shanghai, pocket the difference. But you can't, because COMEX silver is paper and Shanghai demands physical. The arbitrage fails because there isn't enough physical silver to move from Western vaults to Shanghai delivery. This exposed the scam. Western banks scrambled. Trading halts, liquidity warnings, technical glitches. COMEX raised margin requirements by 35% overnight to reduce speculative buying. The London Bullion Market Association issued statements about orderly markets and temporary dislocations. But the cat is out. Silver miners in Mexico and Peru started refusing to honor forward contracts with Western banks, choosing instead to sell at spot prices in Asia. Industrial buyers in Europe began hoarding inventory. Solar panel manufacturers stockpiled 6 months of supply instead of the usual 6 weeks. The paper market is dying. The physical market is being born. And the transition is going to wipe out trillions in phantom wealth Remember the 2008 financial crisis? Mortgage-backed securities collapsed because the underlying assets, houses, weren't worth what the derivatives claimed. Same blueprint. Silver derivatives are priced as if physical silver exists in proportion to paper claims. It doesn't. When Shanghai diverged, banks faced a choice: deliver physical silver and drain vaults to zero, or default on contracts and admit the fractional reserve scheme. They chose door number 3, change the rules. COMEX altered settlement terms to allow cash equivalent payments based on London prices, not Shanghai prices. That's fraud dressed up as policy, and it won't hold. Because once trust breaks, markets don't heal, they collapse. China knows this. They've been preparing for decades. The Belt and Road Initiative wasn't just about infrastructure. It was about creating bilateral trade agreements that bypass the dollar. Digital yuan pilots are already integrating gold and silver backing for international settlements. While Western banks played with paper, China accumulated metal. The transfer is happening right now. Wealth is flowing from paper claims in New York to physical assets in Beijing, and the speed is accelerating. Let's quantify the scale. Global silver production, 830 million ounces annually. Industrial consumption, 670 million ounces annually. Investment demand, 240 million ounces annually. Total demand, 910 million ounces. Annual deficit, 80 million ounces. Above ground, silver inventories have fallen from 3 billion ounces in 2000 to an estimated 1.2 billion ounces today. At current deficit rates, that's 15 years until physical exhaustion, but demand is accelerating, not stabilizing. Meanwhile, paper silver trading volume on COMEX averages 420 million ounces daily. That's half the annual global production traded every single day. In London, it's worse: 650 million ounces daily in unallocated accounts. The leverage is unsustainable. And Shanghai's $75 price is the margin call. Here's the dark part. The 1971 gold default took decades to fully play out. We got stagflation in the 70s, the Latin American debt crisis in the 80s, and multiple currency crises in the 90s. Each one was a delayed consequence of severing money from reality. This silver crisis will be faster. Technology has accelerated everything. Information moves at light speed. Capital flows are algorithmic. When trust breaks in one market, contagion spreads globally in hours, not years. The Western financial system is built on borrowed time and engineered illusion. Every time it nearly collapses, 2008, 2020, 2023, central banks print money and kick the can. But you can't print silver. You can't quantitative ease industrial metals. You either have it or you don't. China has it. The West has IOUs. And when the reset happens, when paper claims collapse and physical assets reprice, your savings will be caught in the crossfire. Not because you did anything wrong, but because the game was rigged from the start. This is the permanent, secret consequence of the paper gold system. The separation of real wealth from financial wealth. The people who own paper think they're rich. The people who own physical assets are actually rich. And the gap between those two realities is about to become a chasm. Denial won't save you. Hoping the system self-corrects won't save you. The institutions you were taught to trust, central banks, commercial banks, rating agencies, are the architects of this collapse. So here's the question. Are we wiser now, or are we walking the same path in better suits? Drop your thoughts below. Share this with someone who needs to understand what's really happening. And subscribe, because the next chapter of this story is already being written in markets most people don't even know exist. The silver price is a warning shot. The question is whether anyone's listening.